Central bank cash, the opiate of the masses. Well, the Euro, FX and bond markets at least, as both continue to pin their hopes on Mario Draghi turning on the stimulus taps again on Thursday. I'm Jamie McGeever and this is today's Market Pulse. In today's show then we'll be talking the Euro and the Aussie after Australia's central bank left interest rates on hold. With me is Reuters FX analyst Neil Kimberley. Neil, the Euro's coming off a tad right now, but it's still trading reasonably firmly, closer to 130 than 120. Is there any juice left in this rally?
I think there might well be some juice left in it, Jamie. All obviously going to depend on what Mr Draghi does on Thursday. You've seen some action already in the bond markets after Draghi's comments yesterday in Brussels. Essentially today we're coming in around 126, the figure. People coming back from holidays. You know, if you look at the data, with the latest volume data we had from CLS for July, as well as the ICAP and Thomson Reuters data, volumes were pitiful. And we know already that August is a bad month for foreign exchange because everybody's out. People are coming back in September. They've got September, October, November. Forget about December, it's always a write-off. They've got 3 months to make their money. They need a move. And coming in today, Mr Draghi is making all the right noises. The line of least resistance is to believe in the Draghi put. It's to believe that the euro can move higher.
How does that square? Last week we had Ben Bernanke opening the door to QE3, bond yields fall, dollar falls. Mario Draghi opens the door to bond buying, yields fall, yet the euro rises.
Well, no one ever said the market was rational, but essentially in the case of Mr Bernanke, risk assets, you know, the risk on, risk off thing. In the case of Mr Draghi, it's on one level, I think, the fact that he's threatening to do this, although my view is it's a more nuanced view than that he's going to go and pile into the 3 years. I'm not sure that's necessarily the case. But the point is, what we've lacked in Europe is somebody to head it. We haven't had the steady hand on the tiller. Mr Draghi seems to be taking this by the scruff of the neck, and the market is happy to go along with that because, as I said, the market needs a move.
Okay, what are the key levels you're looking at right now?
Well, on the day, as I say, we're messing around 126. Probably the interbank market's a little bit long. There are some very good bids around 125, 70, 80. Below 125.45 is where the stops are. I don't think we've got the legs to get that because no one wants to be too short because you don't know what they're going to say next. On the top side, real money offers coming in at 126.40, 50. And I think that's enough. That broad range is enough to take us into Draghi. But come Thursday, if he says the right things, you've got to be looking at that 200-day moving average around 128.50. And if we saw it up there, I'd start to be squaring up because I don't think this picture is as straightforward as perhaps the market wants to believe it is.
Okay, let's move on to the Aussie. It's given back almost all its gains that it had in the immediate aftermath of the RBA keeping rates on hold at 3.5%. But major support lies at 102, is that right? There's
a big barrier down there, Jamie, 102 the figure, and the Australian banks have been telling me for a couple of days now that they've got a good demand for Aussie between 102.30 and 102 the figure. Now there's a lot of people who caught this move earlier. You may remember a couple of weeks ago there was that news report in Tokyo that the Bundesbank was going to start buying Aussie dollars. Well, that seems to have been the trigger for a number of other people to go short. And as far as I can tell, they're still riding the wave and they're picking them up down here. But the bottom line is everybody's looking at everything that comes out of China. And as the China stuff is negative, you know, the price in iron ore has gone down, all the mood music from the Australian commodities industry is a bit downbeat.
So is it all that to say then that the market is love affair, if you like, with the Aussie, is that coming to an end?
I think it broadly is at the moment. I mean, for example, we saw a squeeze back up last night, but between 102.80 and 103 the figure now, I know a lot of people who are happy to resell the Australian dollar. All of a sudden, the Aussie dollar has become a sell on rallies rather than a buy on dips. Now, it may well be that the market's misinterpreting what's happening in China. It may actually be worse than they think. People are expecting China to throw money at the situation. I'm not sure that's the case this time around. I think they may just be trying to stabilise it. If the value of the Australian dollar at these elevated levels is based on China going full throttle, the market may have to reevaluate this. If China's going for lesser economic growth, a more stable position rather than what we've seen before, Aussie dollar may have to go back below parity. And for me anyway, never trust the Aussie with the one in front of it.
Okay, Neil, thank you very much. That was Reuters FX analyst Neil Kimberley. Join us at the same time every weekday for Market Pulse, a snapshot of what's moving on financial markets and why. I'm Jamie McGeever. This is Reuters.